Hey there, class. It's Phil McDowell, the mortgage professor, coming to you today. And has it been an interesting week as far as mortgages go in Calgary this past week? What was the big news? It was the Bank of Montreal suing hundreds of people over a mortgage fraud scheme that took effect in 2006. Now, according to the news reports, Bank of Montreal wasn't the only one hit with this massive mortgage fraud. It actually had 16 other financial institutions that this group of people, this nefarious criminal underworld, allegedly created situations where there was a big mortgage fraud. Now, a lot of questions are coming out because mortgage fraud affects us all in terms of the ultimate end game cost of mortgages. So people are saying, oh, okay, now that the Bank of Montreal has sued these people in a civil court over this mortgage fraud, how will that affect me applying for a mortgage tomorrow? Because it's all about me, isn't it? Of course it is. Now, I did say on one newscast that what you will find is that mortgage brokers and lenders, if you go to them directly, will be asking you more questions, asking for more documentation. So you will find it perhaps a little bit more frustrating that people are acting like they don't trust you anymore. Well, they didn't trust you anymore anyway. They just didn't do their due diligence before. So here's what the game is as far as interest rates. Are they going to go up because of this uncovering of this massive mortgage fraud, the biggest one in Canadian history, according to the news reports? If the banks want to take advantage of the news report, they will start creating increases of interest rates. There are other factors that have already affected interest rates that are out of control of the banks, and that's the international community and their worries about Greek debt. Now, there's a different mortgage segment that I did before about when these pigs fly, pigs being Portugal, Italy, Greece, Spain. Now, there could be another Ireland in there, not just Italy. So they're interchangeable. But here's the point for you. What I've done is I've taken a look at the banks can make an investment in anything they want where they've got money. One of the common benchmark strategies is to take a look at an investment that typically is no fuss, no muss, very little administration, very little risk, and that, of course, is lending money to the Government of Canada, which is Government of Canada bonds. Now, we hear about fixed mortgage interest rates have a loose correlation to Government of Canada bonds. So what the banks say is, listen, if I'm going to go into the residential mortgage marketplace, compared to Government of Canada bonds, mortgages have more administration and they have more risk, as evidenced by this massive mortgage fraud. So what have the traditional, what we call spreads, the difference between Government of Canada bonds and mortgage rates have been over time? Now, prepared a little something for you. And what this is this starts from April of 2000, and it goes through all the way through till April of this year. And you see a little graph, and you'll see that there's 2, 3, and 4. 2, 3, and 4 is the difference in the interest rate or the spread between benchmark bonds, 5 years, compared to a 5-year mortgage rate that the banks post in the newspaper as being their posted rate. Now, what you'll see is something interesting. All the way from 2000, all the way until 2007, it's been about a 2.5% difference between the 5-year benchmark and the 5-year posted rate on mortgages. But now you notice that, wham, in 2008, there's almost 4% spread. At one time, in December of, when was it? 2008. It was over, like it went off the charts. It was 5%. Now, what that was is in 2007, in about August of 07, that's when the U.S. subprime concerns were entering the marketplace, caused some real heat in the financial marketplace. So anything that dealt with fixed term had a premium on it. Then came the December 08 stock market crash. So a little concern in the marketplace. But realistically, when we talk about those mortgage frauds that occurred back in 06 and 07, what the banks have been able to do, not just the Bank of Montreal, but those 16 other financial institutions that would have been aware of these frauds already in 06 and 07, what they have had is the opportunity to boost up this spread so that instead of being an average, as it was all the way from 00 to 07 of about 2.5%, the average has been 3.5%. So they've had a risk and administration margin increase of 40% since 07. That's a lot of time to be issuing good, sound, solid mortgages, properly underwritten, at a premium price to make up for some of the consequences for the activities that were done back in 06. So that means that because of this fraud, your mortgage rates should not go up. They already have gone up years ago. So watch your money and watch them.